Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Today, I'm joined by Rob Petrini, who is the co-head of Performing Credit as part of Blackstone Credit. Rob, welcome.
Alex, thanks for having me.
So today we're going to be talking about private credit. It's been an incredibly fast-moving trend in the Australian marketplace. Can you maybe walk through what you do in the private credit market and what are your thoughts around this large increase in investor demand that we've seen probably in the last 3 years, particularly in the Australian market?
Sure. So as you mentioned, I'm co-head of Performing Credit at Blackstone. I really focus on a host of different products, but all within the performing world. So companies that are performing well, moving in the right direction, and looking to make investments in those companies. So get to see really in my role a very broad swath of what's going on out there. And when you think about private credit, rather, it's really a pretty broad asset class. So it covers a bunch of different kind of funds, right? There's more senior-oriented funds, more junior-oriented funds, and it's been something that's been around for quite some time in various forms. But it's really taken off in the past 10 years. And so when you think about what private credit is, historically, a company would go to a bank to get a loan. They'd hold that loan on their balance sheet, or they would syndicate out the risk to others. Instead of what's happening in private credit is those companies are borrowing directly from funds like the funds I'm associated with, who then hold the loans themselves. And they're then negotiating on a bilateral basis with the company to offer them a private debt transaction. And that could be in the form of a first lien deal, a second lien oriented deal, unsecured, mezzanine, really anything and everything. And I think one of the advantages is obviously you do have the ability to structure it in any way that makes the most sense for that pocket of capital.
So as you're thinking about the types of companies that have been moving into this space, or at least using it to source capital, have you seen a transformation in those types of businesses or particular sectors that have moved into private credit?
Yeah, it's actually pretty interesting. So when you think about when private credit really took off, it took off during the global financial crisis, which makes a good amount of sense, right? Because you had the banks pulling out, no longer able to carry risk on their balance sheets the way they had been historically, and really moving away from the debt markets. And the reality is, in the United States, we've actually seen the number of financial institutions decline something like 69%. Since the mid 80s. And so where private credit first made inroads was in smaller deals, in middle market deals, where the banks just weren't focusing on it at all. And then over time, what you saw is an expansion of that. And so the reason you've seen that expansion is I think private credit brings a lot to the table, and that's probably a good discussion to have. But there's a lot of things that they can provide, we can provide in private credit that are harder for a bank to provide directly to issuers. But we have in fact seen the market start to expand, particularly into some of the larger companies. And it's an example of kind of the lower end of the market from a size perspective, actually innovating and then delivering that up to some of the larger companies as they saw some of the advantages. And so what we're seeing today is much larger transactions in general, as some very large sponsors and some large companies are actually looking to get the same benefits out of the private credit market that the middle market and lower end of the market have been doing for some time.
So as you look at the types of deals that are being done, you mentioned about the private credit space provides more help to the people that are looking for money. What does that look like? Is it the flexibility? Is it the ability to work more closely with the issuer versus a traditional bank? What else is being offered that makes people go down this particular route to take private credit versus just doing a public offer?
Yeah, it's a good question. Ultimately, I think there's a number of things that we bring to the table, and every situation is a bit different. But speed of execution is a good example. We have the ability to control our own process and really get things done on a timeline that can be pretty well refined. Certainty to close. We're investing for our own account, right? And so we don't need to go out and syndicate debt, for example. We know where it's going to go. Structuring flexibility. we're not really tied into a specific structure. We have a bunch of different funds, and the private credit universe has a bunch of different funds that can really solve a whole host of different products and really be more creative. Now, one of the other things I think that we've seen over time is a lot of the parties who are accessing the private credit market repeatedly, they really appreciate the fact that they're dealing with a single sophisticated holder. And that's a holder who has a partnership mentality, right? Because they're going back into the market repeatedly, dealing with the same parties again, and their reputation is important. And so you get into a difficult situation, that party's a lot more likely to be rational, and that ultimately leads usually to a better outcome for everybody. And then there's a lot of smaller things. It's candidly less distracting to management teams because there aren't things like a roadshow or rating agency presentations that need to get pulled together. And then finally, what I would say, we're looking to ultimately not be just a commodity capital provider. So in a lot of instances, we're able to bring expertise to the table that's pretty differentiating. Maybe it's a diligence angle or operating knowledge or access to other parts of our portfolio. But really trying to position that private capital as differentiated and not just the cheapest capital provider.
That was my next point, which is around whether private credit is actually more expensive than public, and you've given an example of not just being commodity capital, and there's other sources that you can almost sell towards as well. How, I guess, for potential companies that are looking to issue via the private space, is there a potential sweet spot for the size of loans that are done via private versus then going to the public market?
Yeah, increasingly, I would say there is not a sweet spot. Historically, certainly it has gotten bigger over time, right? And so if you'd have asked me that question even a few years ago, I would have said $150 million starts to become a fairly big deal in this market. But today, we're seeing deals pulled together of $1 billion plus. And so that goes to my earlier point of really having seen the market expand pretty meaningfully. And again, it's just larger companies seeing a lot of those advantages that I laid out and saying that, well, we want to take it. We want to have those same advantages. And to answer the first part of your question, it usually is coming at a premium. I mean, we're not trying to price private capital directly on top of where the public markets would price. You have to remember, we're capturing things like fees in the private credit universe and delivering those directly to our investors. Whereas in a public environment, you've got a bank who's capturing those fees for themselves, and then they're really looking to place the debt as inexpensively as possible, right? And so really working it down to the lowest common denominator by placing with a bunch of different parties. And so there is usually a premium, but the best clients in private credit recognize that it's worth that premium.
Let's maybe go into the types of companies that you're looking at, and as you're sourcing these deals, that's obviously a really critical piece. And banks historically have had the network more broadly across the country, across the world to get these access to deals. How do you look at sourcing these deals, and then ultimately, how do you then work out which are the ones that you want to do versus the ones that don't fit with your remit?
Yeah, well, look, that's kind of the magic sauce, right? Is you need to be able to source the deals, or the whole thing falls apart pretty quickly. And so, what I would say is, at a high level, not all platforms are created equal, right? So as I mentioned, the private credit universe is very, very big, and so there's a whole host of different ways to play it. In some instances, you've got basically what are club debt deals. So they're organized by a third party placement agent who's been hired by the company to go out and just find private credit providers to come into their deal. My view is that you really want a more differentiated origination platform than that, because that starts to feel a lot like the syndicated market of the banks of the past, right? You've got somebody who's out skimming the fees. They're looking to place the paper. You don't have direct access to the management team or the company necessarily the way you normally would. A more differentiated platform is going at it much more directly, and so you would expect to have, for example, a sophisticated sponsor coverage effort where you've hired people who are specifically engaged with the whole sponsor community and staying in front of them and making sure that they know all the different advantages that you can bring to bear. If you're part of a larger organization like we are, you're harvesting ideas from that organization, right? Like looking at different parts of the business, trying to harvest relationships that come out of a private equity part of the business or a real estate part of our business. That all leads to better deal origination. We're developing direct company relationships in many instances. There's lots of third parties who are looking to introduce deals into the system as well. And so, there is no one way, right? And what's nice about it, and it varies in different parts of the business, but it really is, what you want it to ideally be is a virtuous cycle, right? You do something that's special and unique, and then you can go out and advertise that you did this special, unique thing and then replicate that, right? And so that's really how we try to source it. But we want to have a very large funnel. If you think about investing as a funnel, you want the top to be really, really big, to capture as many deals as possible. And then you want the investment process to narrow at the bottom to eliminate the worst deals.
Do you find that a lot of the companies that you work with are repeat clientele, like they're growing as as a business, and now your loan book to them has increased?
Yeah, it's interesting. So a big part of our business is driven by sponsor relationships, right? So private equity firms who are out repeatedly buying companies, and those are some of our best repeat customers. So if we develop a good relationship institutionally with them, and then personally for a lot of our the individual members of the team, we do see a lot of repeat business. And so I think, off the top of my head, I think the most we've done with any individual counterparty is something like it's north of 15 deals. So quite a few. It's also the case that once we've been a lender to a company, think of it as, sort of the home court advantage, right? You're in the company, it, you develop a relationship with the management team. Hopefully that's been a positive experience. And so you do have a good position if the company wants to refinance, or if it wants to go and do a new deal, or if it sells to a new party, for example. The other thing we'll do just on this topic is, because we do have a lot of capital, what we want to do is kind of land and expand, right? So make an investment and then grow with that company, provide it the capital to continue to grow, help it do acquisitions, help it fund its growth plans, and really be a part of that company's success. And again, that breeds a good dynamic. The other interesting thing apart about that is it does give us an advantage over, for example, a bank run syndication, because in most instances, it's hard to tack onto that deal. So they're usually going out and doing a full refinancing, which takes longer, a lot more fees, and just ends up being more expensive.
Mhm. Well, as you now flip to the other side and you look at private credit from an investor point of view, how do they think about the risk to return trade off across the market? Private credit obviously is not a homogenous group; many different types of lenders on the other side. How do you think
Yep.
about, or how should an investor think about that?
Yeah, so I'm obviously biased, since this is what I do for a living and have been doing for basically ever. But I think it's a really compelling opportunity for investors. And when you take a step back and think about it, the real question people need to ask is, do they have room in their portfolio for illiquidity? Because that is really the primary negative from an investor's perspective, is that these are not liquid loans, right? We're usually investing, and we're coming out when we're either refinanced, or the company sells, or is sold, and we get taken out as a part of that. And so if you look in basically all of our portfolios and you think about how we come out of deals, the vast majority is always because of sale of the company or refinancing. And so they are illiquid, but they come with a substantial illiquidity premium, right? In general, our coupons are higher. I mentioned already that we're capturing fees. So the underwriting fees that a bank would charge, we're capturing those and distributing those to our limited partners, or our investors. We generally have better call protection. And what I mean by that is that, if they take us out or refinance us early, we get paid a fee because of that, which drives a better multiple of capital. And so when you add that all up, you could be looking at a couple 100 basis points, depending on the strategy, more of illiquidity premium. And so the real question is, in a difficult environment to find good yield, is that worth it? In my view, the answer is yes. And then how loudly you say yes to that will depend on how much you can tolerate the illiquidity. I'll also point out that the illiquidity that comes with some positives, right? You're not going to have the same volatility in this portfolio that you would in a portfolio that gets marked to market and gets traded regularly publicly. So you should expect more stability from that perspective. And then from a core risk perspective, it's hard to argue that we don't understand our companies much better than you would in a public market deal. We're doing direct diligence. We're getting to know these management teams. We're getting to know the owners. We're sitting on the boards of directors in many instances. And so we know these companies. We know our portfolios like the back of our hand. We negotiate much better documents. And so we're negotiating the documents that exist here, the credit agreements and alike, for, again, our own account, for our investors. And so we take it very seriously. And in general, you're going to see them being much more restrictive than you would in a typical leveraged loan document, for example.
I guess you could also say that to some degree you're also a little bit more flexible in terms of when there is distress or coming up to a default too. So it's not just being restrictive, it's you've got that understanding of where the business is trading at and where they potentially may need some additional help.
I think that, look, I think that is a really good point. The reality is that a lot of the time when you see carnage in restructurings, it's because people make bad decisions, right? And so, we're not we're not obligated to make bad decisions. We don't have a structure which forces us to do things that are economically irrational. We understand that what's going on with these companies. We understand when they need money or when they just need time or space. I think COVID has been a great example of that, right? Where we were in a completely unique environment, and a lot of our portfolio companies across the platform were in a period of not really knowing what to face, because nobody knew what was ahead of us. And so I think acting in a thoughtful way has really differentiated us with a lot of our clients because of that. And I think it's going to lead to much better outcomes at the end of the day.
You mentioned the issues around COVID earlier last year. I'm curious to get your thoughts on terms of what was March and April 2020. Was that just a dislocated market, or was that just an opportunity for distressed credit to really to prosper? I guess as an opportunity set.
Yeah, well, look, it was unique in my career. I've never seen anything like it in terms of just the speed with which things went down. You're obviously facing an environment where a person I know phrased it best is like, not only am I worried about my portfolio, but I'm worried about my health at the same time, right? So there's a lot to deal with, and you were seeing the sharpest operating declines in some of our portfolio companies that any of us have ever seen. So very, very, very unique, and the markets reacted accordingly. It was definitely a stressful time to be an investor. You saw a lot of capital raised during that period, and a lot of that capital was really raised with the notion of being distressed focused. That is not, you hear it in what I do. I'm on the performing side. Now, that doesn't mean we're not doing opportunistic investing. We are in fact doing opportunistic investing, but we don't really focus on companies that would, for example, be deeply impacted in a potentially permanent way by COVID, right? If the company trades off, or if there's an opportunity to invest at an opportune time that otherwise wouldn't exist, well, that's great. We want to take advantage of that for sure, but we don't want to be taking core operating risk. And I think a lot of the capital that was raised was really focused on investment grade, or sorry, was really focused on distressed, quite the opposite. And my personal opinion is that you probably raised too much capital during that period. And so, you quickly saw a change in the markets that was driven not by the fundamentals or the operating performance, because we really haven't gotten through this yet, but much more by just the amount of capital in the markets, a lot of the actions that the government took. And so I think there was a period of time that was much shorter than probably almost any of us would have forecast, where you could have made some pretty compelling opportunistic investments, but that turned around pretty quickly. And now a lot of the dynamics that exist in the market today are much more driving us to a healthier environment where, if anything, we're seeing returns compress.
I want to go back to March last year and April last year. We saw a lot of government impact, a lot of stimulus loans and so forth. How much did that affect your sector?
Well, I think where it affected us. So there's a couple different ways. When you kind of look back and think about what we were doing at that point in time, there was a lot of soul searching and individual company analysis within our portfolios of what companies could benefit from direct stimulus, right? So take the aerospace industry. Was there an opportunity to take government money? Now, I would say by and large, our portfolio was not particularly meaningfully impacted by that. In most instances, we really were not, our portfolio companies were not beneficiaries of that. I think where we were impacted was with the speed of the recovery of the capital markets in general, right? So I think what we saw was very quickly capital rushing back into the market which turned on its head the dynamic that we were seeing from a secondary market, and then over the course of a few months, sort of changed the primary market as well. And so there's no question that the rapid action of the government, I think, really turned the markets around. But if the question is more directed at the specific capital injections, that we were not particularly impacted by those, is the reality.
I asked the question because a number of the institutional investors are, I think, always living with the hope that governments will come in to support markets when they come,
Yeah.
when there's a problem. I hear it all the time in different advisory boards that we hold. And so I asked the question because is there now going to be this expectation that whenever this credit part of the market starts to get into trouble, that there will be more support?
It's a great question. I don't think that the government's acted with the intent of preserving the credit markets. I think the government's acted with the intent of preserving the economy, right? So if you look at how rapidly I'll speak about the U.S. government, but it's true for most of most governments around the world, how quickly they acted compared to, for example, the global financial crisis. I mean, it's pretty remarkable, right? Now, some of that's lessons learned, but a lot of it was just dealing with a very specific and unique situation with a known end. You didn't know when the end was going to occur, but you knew that you needed to kind of bridge to a period where people could go back to work, where you could understand what you were dealing with and really try to get through to the other side. And you very obviously were dealing with things like extraordinary unemployment and extraordinary operating distress in a lot of sectors. And so I think that really got the government to act much more quickly than they would in virtually any other situation. But that's very much my personal opinion. I don't think it's necessarily the case that next time we see the credit markets trade off for more normal reasons that we'll see a government step in. I think that's a much harder sell.
Now, let's go back also to another point that you talked about. There was a huge amount of capital raised. So I asked the question then in terms of, is there just too much capital now in this sector? And will it compress, obviously, the opportunities that are out there and the potential yields that are available?
Yeah, I think the answer to that question is a little bit dependent on what part of the market we're talking about. Now the reality is that a lot of the capital that was raised was targeting the distressed opportunity or the perceived distressed opportunity. Now, what we have seen is an extraordinary return or extraordinary tightening of returns in the distressed sector. So across the board, in a very short period of time, what we saw was the return profile in these distressed funds, or certainly the reasonable return profile for these distressed funds, compressing significantly because there were a lot of funds pursuing the same set of opportunities. And so, when I look at the distressed markets today, they're candidly quite hard. You're just not getting any kind of meaningful premium for taking operational risk that makes sense to me. And so, I do think you've seen too much capital raised in certain areas. When you look at something, for example, like regular way direct lending, that's a much different story, where we're really seeing direct lending continue to take share from regular way bank lending. In that part of our business, as an example, we've never been busier, and we're seeing terrific opportunities across the board. And that really is because you're seeing a secular shift in that market to just kind of natural growth. So the answer to the question really varies depending on where we're talking about within private credit. But I think there's little question that this distress has come under undue stress, if you will.
Let's transition to another really big issue, which is around transparency. And I wanted to ask if there's any sort of material differences between sort of the public and private issuers, particularly now as there's more and more focus on the environmental, social, and governance concerns that many of the institutional asset owners are more and more worried about.
Yeah. Look, I think one of the big advantages that we have as private credit lenders is that we do get more information. So taking a step back, I've talked a little bit about how the diligence process is so much more detailed, right? We're spending months with the company before we invest. Well, those relationships we develop, they continue on after we make the investment. And we are typically a part of the board of directors, for example, whether that's as a board observer or a board director, or actually having a board of director seat. But in almost all instances, we do have some presence. which I think obviously gives us a greater level of information on the company than you would have just as somebody who bought a loan in the syndicated markets. Similarly, when you think about the reporting we get, we're typically getting monthly reporting. So each month we're getting all the information that, for example, the financial sponsor would get, or certainly a good subset of it. And so we're able to really trace and track what's going on with the company on a month-to-month basis. And I think that is quite helpful. Now, hitting on ESG specifically, this is a huge focus at Blackstone. This is an area where we want to be a leader. We have integrated our ESG considerations into our diligence process. Every investment committee memo includes an outline of ESG considerations and really highlights all the concerns, if there are any, and positives, if there are any. We've worked it into operational processes. We have operational folks who help our portfolio companies be better at ESG. And so this is something that we really take very seriously. I think it's something we can certainly continue to do better on. It's something that we will continue to do better on. And you said it. It's amazing the dialogues I'm having today, the frequency with which this topic comes up is amazing compared to what it was even a few years ago. And so this is going to remain something that's very important. It's important because the people investing in our funds care about it. And it's important because it's just important, right? Like this is what we should all be doing. And so, I think being a part of a large organization, we've got a lot of tools that help us monitor things like this, whether it's performance of the underlying portfolio companies or in terms of some of the commitments that we've made to make our portfolio more ESG friendly.
Well, the real hard part in this particular market is if there is some particular social issue, whether it's a labor issue or it's some other environmental issue, there's an actual impact to the underlying business. So it's not just the flag that there's a problem. The underlying business can be affected, whether it's a lawsuit or it's losses just because of the damage that they now need to repair, for example, or to rectify.
No, that's right. Look, I think the long-term health of these companies is enhanced by being focused on these issues, and whether it's focusing on diversity at the board level or focusing on making the right decisions from an environmental perspective. These are important things to the success of these companies long term, and by focusing on them, we're making them better companies. And honestly, we want to get away from investing in companies or industries or sectors where that's we don't feel good about it.
Is it possible to put some sort of other covenants, or triggers that cause penalty to these organizations for doing, issues that maybe are against what you've agreed to at the start of the deal?
Yeah, I mean, look, it's something that we're actually exploring is how do you enforce, and it's not necessarily obvious, nor is it the case that it's going to be the same in every situation. One of the disadvantages we have as a private credit business versus, say, a private equity business is we don't own these companies, right? It's not as easy as walking in and saying you'll do this because I'm the boss. We do have to try to manage these things to some extent, but by leading by good example and the like. We certainly can have them rep to what they're doing. We can certainly do diligence around it. It's pretty atypical today to have something where there's actually a penalty that comes into play because they don't continue to do those things. But we're open to any and all suggestions, and I think you're going to continue to see this topic substantially evolve in the near future.
Let's move to the final topic, and that is, where is the risk in this space? A lot of Australian investors, institutional investors, have been looking at this asset class. Now, this asset class is obviously not homogenous. How do you talk to them about that process in terms of, as they're looking at the asset class, what should they be considerate of?
Yeah. So, look, I think to understand credit investing in general, what you have to really ultimately accept is that you're going to have manageable downside risk, assuming that the process is working well, but you're also going to have limited upside as well, right? It's not as if you're going to invest in a direct lending investment and make 3 times your money. And so what all that means is that in this sort of investing, mistakes really get magnified. It's very important to get it right. Principal impairment is going to really impact returns.
I also have to just ask one short question, and I know there's no simple answer to it, and that is around how do you relatively work out where does this fit in the portfolio? Is it a comparison to some sort of high yield listed market, or is it just a standard index like a a global ag plus 2% or 3%. What are you seeing, I guess, in terms of asset owners?
Yeah, it's typically the case that we're compared, and I will caveat up front, this varies dramatically by our partners, and we get asked all the time. It's typically the case that we're compared to, and I should also caveat that it depends on what fund and what strategy, but we compare to some index. So let's say it's the leveraged loan index, and then it's usually some premium, right? And so in our direct lending business, it would be the leveraged loan index plus some premium. In our capital opportunities fund business, which is more junior capital, it's the high yield index plus some premium. And so that's usually how we're compared. But the reality is, if we were to look at 10 limited partners, you may have 10 different different benchmarks that they use.
All right, that's been a fantastic conversation. Thank you very much for your time today, Rob.
No, it's a pleasure. Thanks. I welcome the conversation, and thanks for having me on.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.